Good morning, I'm Maiki Oreta, and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. Wall Street suffers its worst drop since 2020 after President Trump announces sweeping global tariffs. Despite a 17% tariff on Philippine exports, top officials remain confident that the economy can weather the impact. And 3 Filipinos are arrested in China, accused of spying in a case that could further strain ties between Manila and Beijing. First, let's take a look at how global financial markets performed on Thursday, starting with developments on Wall Street. Wall Street's benchmarks suffered their biggest single-day losses in years after U.S. President Donald Trump's sweeping tariff announcement sparked fears of an all-out trade war and a global economic recession. Investors fled risky assets in favor of safer government bonds after Trump imposed a 10% tariff on most U.S. imports and even higher levies on dozens of countries with large trade surpluses. The move marks a sharp turn from just a few months ago when stocks surged to record highs on hopes of business-friendly policies under the Trump administration.
Well, the market was down today because the tariff announcement ended up being more extreme than most investors had anticipated. And because of it being extreme, investors are now worried about what the reciprocal tariffs will end up being with the retaliatory tariffs by our trading partners, how long these tariffs will be in effect, because the longer they are, the deeper this market is likely to decline, because the longer that they are in effect, the weaker our economic growth and corporate profit growth will likely be. So investors are attempting to get ahead of the fundamental fallout from the taxes by selling now.
It was a bloodbath on Wall Street. The Dow Jones Industrial Average dropped 4%. The broader S&P 500 fell 5%, while the tech-heavy Nasdaq Composite plunged 6%. Over in Europe, the UK's FTSE 100 slipped 1.6%, Germany's DAX lost 3%, and France's CAC 40 shed 3.31%, despite stronger than expected manufacturing data and solid corporate earnings. U.S. President Donald Trump said on Thursday that the market slide following his latest tariff announcement was expected, insisting that the measure is needed to heal the U.S. economy. The comment comes amid growing global uncertainty, with investors worried that a new round of tariffs could spark another trade war and further slow global growth. According to the Nonpartisan Tax Foundation, the average American household is now expected to pay an extra $2,100 a year for goods as companies pass on the cost of import taxes onto the consumers. Trump said he remains open to negotiating tariff deals with other countries.
First, we'd love to get your reaction, sir, to what's going on in the financial markets today.
Well, I mean, it's to be expected. This is a patient that was very sick. We really inherited a terrible economy, as you know, with a lot of problems, including loss of manufacturing and plants closed up all over the country. You know, we've lost 90,000 plants since NAFTA, if you think of that. 90,000. It's not even believable. And about 6 million jobs. And so it was a sick patient. It went through an operation on Liberation Day. And it's going to be a booming country, a very booming country. It's going to be amazing, actually. And we see it because we have trillions of dollars committed to come in, trillions.
French President Emmanuel Macron called the tariffs brutal and unfounded, describing them as a shock to international trade. He said European companies should suspend any planned investments in the U.S. and urged a unified response from Europe to the escalating trade tensions. Finance Secretary Ralph Recto says that the Philippine economy remains resilient despite U.S. President Donald Trump imposing nearly 20% tariffs on Philippine exports. Sujin Kim has the details.
Despite the impact of new U.S.-imposed tariffs on Philippine exports, Malacanang's economic advisor Frederick Go remains unfazed, even calling the move an opportunity to attract investors and grow exports.
For me, I think my point of view is this is a reality. No, I think if you want to keep being in denial, it's up to everybody. But to me, this is an opportunity to attract investments.
The United States imposed reciprocal tariffs on imports from key Asian exporters, with the Philippines facing a 17% rate, significantly lower than Vietnam at 46%, Thailand at 37%, and China with 34%.
I think if the Asian countries that have higher tariffs would set up manufacturing facilities in the Philippines, that would be music to our ears. No? That's exactly why we have Create More. That's exactly why we have we put in all these incentives in the Create More Act, no, to attract them to come to the Philippines. And now they have an added reason, apart from our fiscal incentives that we provide them.
Finance Secretary Ralph Recto echoed Go's sentiment, saying the Philippine economy remains relatively resilient amid global trade shifts thanks to its domestic demand-driven structure. Recto added that the country's stronghold in coconut oil exports gives it an edge under the new tariff landscape. He also stressed the need to diversify export destinations beyond the United States. Meanwhile, on the side of the Department of Trade and Industry, Secretary Roca said she views the tariff shift with guarded optimism, underscoring as well the importance of seizing the so-called advantage. The department also noted that certain products, including copper ores, concentrates, and integrated circuits, are exempted from the tariff hikes. However, it is closely studying the potential impact on agri-based exports, which were not included in the exemptions. Roca said the Philippines will push for enhanced market access for exports such as automobiles, dairy products, frozen meat, and soybeans. Finally, the American Chamber of Commerce of the Philippines, or AmCham, said it remains committed to strengthening economic ties. Sujin Kim, Bilyonaryo News Channel.
As global uncertainty rattles markets and supply chains, Philippine CEOs remain cautiously optimistic about the year ahead, signaling resilience in the business sector despite headwinds from trade policy and geopolitical risks. According to the latest EY CEO Outlook survey, 62% of Filipino chief executives say that they are somewhat optimistic about the local business environment over the next 12 months. Nearly half of the respondents, 46%, say that they have high confidence in the global economic outlook, while 48% remain bullish on their own industry's growth potential. The survey comes amid lingering pressures from global inflation, tighter financial conditions, and fresh uncertainty over trade policy following the U.S.'s new tariff announcements. Ernst & Young's CEO Outlook Pulse survey gathered insights from 1,200 chief executives worldwide, including 50 from the Philippines. The Philippine inflation rate decelerates to 1.8% in March. Latest data from the Philippine Statistics Authority says this is lower than the 2.1% recorded in February and 3.5% forecast of the Bangko Sentral ng Pilipinas. This is also lower than the 2 to 4% target of the central bank for 2025. The PSA attributes the decrease to the slowest price increase of food and non-alcoholic beverages. Just the other day, former U.S. President Donald Trump reignited global trade tensions, threatening a new wave of tariffs that could add pressure to already fragile supply chains and inflation outlooks worldwide. And now this morning, March inflation for the Philippines has just been released, coming in ahead of the Bangko Sentral's Monetary Board meeting on April 10. To help us make sense of all of these moving pieces, from global volatility to local rate paths, we're joined by Dino Aquino. He's the Vice President and Head of Fixed Income at Security Bank. Hi, Dino. Thanks for being here with us.
Thank you also for having me again.
Okay, so Dino, 1.8%, really nice benign inflation. Seems like the rate cut is baked into the cake, at least 25%. How does this development shift the policy conversation?
I think the overall dynamics, if you look at the inflation outlook, I think it's still tilted to the downside. So moving forward, even though there will be base effects in the third and fourth quarter, we're still looking at the inflation that is pretty much trending to the right direction. Mm-hmm. So that gives room for the BSP to further reduce policy rates.
How much room for this April?
This April, pretty much 25 is already baked, but I can't rule out a 50 if you ask me. Might be a possibility, who knows? But 25 is pretty much baked in already in the market.
With global risks heating up, how much room does the BSP really have to adjust monetary policy, to be dovish?
I think they have a lot of room. The concern of the market is the Fed, actually. Not just the Philippines, but everyone else is concerned if the Fed will cut rates given these tariff risks that are coming.
Yeah.
I think the market is now in a tug of war, wherein the Fed, what will the Fed prioritize, growth or inflation? So now part of the market is looking at a huge amount of cuts. Another part of the market is looking at a pause. So that's given uncertainty to policy rates locally.
Yeah.
But I think the Philippines has an opportunity to decouple, given the fact that we are on solid footing, our currency is pretty much stable, growth is stable, and our inflation benign. So all of those are supportive for the BSP to decouple.
Yeah. I mean, it's in their best interest to boost consumer spending, especially with all of the risks, external risks. The Philippines isn't a major manufacturing hub. We're a net importer. So we're somewhat shielded from all of this relative. I mean, compared to our Asian peers,
like Vietnam, right?
Of course, right. But indirectly, we may feel the impact through investor sentiment and capital flows. How do you see this affecting us?
Going back to our last discussion, one of the goals of Secretary Besant is to devalue the dollar. So right now, on a year-to-date, the dollar index is down more than 6%. So that's the reason why our peso is also resilient. So if the dollar continues to devalue and our peso continues to strengthen, then our import prices will also be lower. So that will also help inflation to be benign moving forward. So I think it's not really that bad of a deal, if you ask me.
Yeah, you mentioned the peso. With the BSP rate cut likely on the horizon and global volatility picking up, what's your outlook for the peso over the next couple of quarters?
I think it will stay within the range of around 56 to 58, that levels. I don't think we will go back to 60, to be honest, given that Secretary Besant's goal
weakening of the U.S. dollar.
Weakening of the U.S. dollar. So it will keep the peso supported.
Okay, that's nice. Okay, so I mean, taking a look at it, we've got benign inflation, CPI on an the BSP on an easing cycle, and the peso being supported by the weakening of the U.S. dollar. Things are looking really good for bonds.
We're on solid footing. If you recall, during our last conversation, I had a buy recommendation on the 10-year, right? That was around 6.26 at the time. Since then, we extended our duration. We even moved further down the curve, even on the 20-year. Fortunately for us, the yields have actually come down a lot, around 15 basis points since then. I think before I got on air, the 10-year is trading below 6.1. So thankfully for that. And I think there's a lot of room for it to move lower, given that the credit spreads are still very wide compared to the U.S.
And in this kind of environment, inflation easing, rate cuts on the table, Philippine bonds are much more attractive than equities. Equities haven't moved in 12 years.
Yeah. I think it was that 6.1 when I entered the trust business, and it's still there, I think. So and in dollar terms, you might actually have lost a lot of money also, given that the fact that the currency was way below 50 at that time. So, but if you look at the bond market, I think it's really attractive. If you compare the spreads versus the U.S. rates opened the year at around 4.6. It's now at 4. It's breaking at 4%. It's going to break 4%. And we're still relatively flat on a year-to-date. So we have widened around 60 basis points. So I think given the solid macro backdrop, we should tighten. So there's a lot of room for local bond yields to move lower.
Yeah, and bonds are interesting now because, I mean, gold's going up, but it's also very expensive. At these levels, would you say the bonds are cheap now?
Cheaper compared to gold. Gold is about 3,000. It's pretty expensive right now. So if you're looking for another safe haven asset, you should go to bonds.
And are we seeing renewed foreign interest in peso bonds?
Yes, I believe so. I think there's a lot of foreign interest, especially with the peso being stable. I think the if the peso remains stable at these current levels, the foreign interest will continue to flow.
And in this kind of uncertain macro environment, what does it take to win in the fixed income space?
It's basically managing duration. Find value in the curve. The first time we spoke, I mentioned the 5-year because at that time the spreads were pretty flat with the 5-year and the 10-year, and it steepened. So I recommended the 10-year last time, and now it actually is still steep. So we might move a little further down.
Right. So if you were to deploy capital today, look at the longer-term tenors.
Yep.
So there's the 10 and possibly 20, 15 and 20.
Yeah, there's a 15 and the 20-year, because the 15 and the 20-year on a year-to-date is still higher. Yield-wise by around 5 to 10 basis points. So that makes it cheap compared to the other tenor buckets.
And lastly, what's the best approach to navigating this kind of economic cycle with all of the Trump risk premiums at play?
Let me go back to my advice to our investors during our first interview. Time in the market is more important than timing the market. Because if you stayed in the market since January, I think you're pretty much in a good place right now.
And leave the timing to professionals like you.
Yeah, that's my job. That's
All right.
what they pay me for.
All right. Thank you so much, Dino, for sharing your thoughts on fixed income and more with us this morning.
Thank you so much.
We're taking a quick break now. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line.
Welcome to Lifeline, your ultimate guide to bridging the gap from where you are to where you want to be. You can also catch Lifeline on Facebook and YouTube of Bilyonaryo News Channel. I'm your host, Karel Herrera, and in every episode we sit down with experts and individuals who faced challenges, embraced change, and discovered what it takes to move forward. Let us all find out right here on Lifeline.
Your professionalism and dedication to delivering news with clarity and compassion have earned you this prestigious recognition. Congratulations, Corina Sanchez Rojas, for winning the Best Female Newscaster at the 38th PMPC Star Awards for television. Only here on BNC, the Bilyonaryo News Channel.
Welcome back. Let's take a look at how Asian bourses are faring this morning following Wall Street's bloodbath overnight. The Nikkei 225 is in the red, sharply in the red, down by 2.5%. Hong Kong's Hang Seng Index also sharply in the red, down by 0.5% in early trade. Shanghai's Composite in the red, but not down by as much, just down by 0.2%. And Singapore's Straits Time Index deeply in the red, down by 2.24%. So early in the morning. And here at home, let's take a look at our market. Recall the PSE index snapped a 3-day rally yesterday, closing at 1.63% lower at 61.46 as investors turned cautious following fresh U.S. tariff announcements. While expectations are for a rate cut by the BSP, that's in play, escalating trade tensions are starting to weigh on sentiment and cloud the near-term outlook. As of 10:21 this morning, the main gauge is in the red, sharply down by 1.23% to 60.70. We've fallen below the 6100 level. All shares index in the red as well, down by 0.9% to 36.33. Taking a look at all the sub-indices, everything is in the red. The financials, industrial, holding firms, property, services, and mining and oil counters are lower, with the property and holding firms and mining and oil counters down the most. Now, at the foreign exchange market, the peso opened at 56.95 against the greenback. This is stronger than its previous close of 57.09. And in a related development, as the Philippine stock market navigates heightened uncertainty, the PSC is taking steps to strengthen its role in the country's financial market infrastructure. The Philippine Stock Exchange has increased its stake in the Philippine Dealing System Holding Corporation to nearly 80%, a move seen to advance capital market integration and operational efficiency. This comes after the completion of share purchase deals with the Social Security System, or SSS, and Insular Investment Corporation. The PSC says it acquired nearly 2% from SSS after meeting all closing conditions, while Insular Investment sold its 0.6% stake. PDS operates key market platforms including the Philippine Dealing and Exchange Corporation, the Philippine Depository and Trust Corporation, and the Philippine Securities Settlement Corporation. The move brings the exchange closer to full control of the country's fixed income and settlement infrastructure, a critical step toward building a more efficient and modern capital market. President Bongbong Marcos creates a high-level advisory council to boost the competitiveness of the country's semiconductor and electronics industry, a critical sector that makes up nearly two-thirds of Philippine exports. Under Administrative Order 31, the SEI Advisory Council will serve as the President's main advisory body on industry growth, promotion, and global positioning. Frederick Go, Special Assistant to the President for Investment and Economic Affairs, will chair the council. Its members include the heads of NEDA, Finance, Energy, Science and Technology, Labor and Education. The council is tasked to align the industry roadmap with the Philippines' broader economic development goals as the country seeks to deepen its role in the global electronics supply chain. Still on national development, after pushing to boost the country's tech and manufacturing edge, the government now faces scrutiny over the pace of infrastructure spending, a key driver of growth and jobs. Infrastructure spending falls to 146.7 billion pesos in December. Latest data from the Department of Budget and Management, or DBM, shows this is nearly 20% lower than the 183 billion pesos recorded in the same month of 2023. The DBM says that the decline is due to high base effects from last year, along with ongoing fund processing for completed and continuing projects this year. Despite the drop in December, total spending on infrastructure and other capital outlays still grew by 10% in 2024, reaching 1.33 trillion pesos from 1.2 trillion in 2023. The figures underscore the government's commitment to long-term growth, even as timing and execution remain key challenges in delivering its public investment agenda. Chinese state media says authorities have arrested 3 Filipinos suspected of spying. A spokesperson from the Chinese Foreign Ministry says the case will be handled strictly in accordance with Chinese law and assures that the rights and interests of those arrested will be protected. At the same time, the spokesperson dismisses as fabricated the espionage cases filed by Philippine authorities against several Chinese nationals, urging Manila to respect the rights of its detained citizens. PNC has sought comment from the Philippine Department of Foreign Affairs, but has yet to receive a response. And that's it for Business 360. I'm Maiki Oreta. Have a good weekend ahead and keep it here on BNC, the Bilyonaryo News Channel.